hear us all right?
Yeah, great.
Well, thanks so much for sticking around this afternoon, guys. We appreciate your patience with us here. My name is Ashley.
My name is Caitlin.
My name is Blake.
And we are representing Montana State University, and we will present our investment findings on Banner Bank. So just as a brief overview, the highlights that you're going to want to watch for throughout this presentation are that Banner has a strong net interest margin and earnings per share in comparison to their peers. We expect to see some pretty significant commercial real estate growth in the near future. They're also pursuing an aggressive growth and acquisition strategy, and they also have a low PE relative to their peers. And all of this is going to culminate to give us a buy rating with 14.5% upside and a 2021 target price of $61.63.
So Banner has an amount of total assets of over $10 billion. They currently serve the Pacific Northwest, including Idaho, Oregon, Washington, and California. Their products include deposits, lending, retirement services, with services in treasury management and digital banking. So their governance includes 11 board of directors. 9 of those are independent. Also, their CEO, Mark J. Greskovich, has been with the company since August 2010. As you can see, this is Banner's loan portfolio, with the majority currently in commercial real estate and multifamily loans, with the second coming up to commercial business loans. So total income increase, this includes interest and non-interest income, has increased 11% from 2018 to 2019, with net income available to common shareholders increased 7% from 2018. Dividends have also increased, and 2019's annual dividend yield was at 3%. And you can see that they've had a steady growth in Banner. Banner has a steady growth in revenues. Banner has also had 5 acquisitions since 2014, with the most recent being Alta Pacific. There are some implications being in Q3 of 2019, they had $7.5 million of expenses relating to this acquisition. And in Q4, they saw a 17.4 quarter-over-quarter decrease in earnings per share. And their synergies aren't going to show until Q2 of 2020. Their net operating margin is also stable.
All right, moving on, we're going to take a brief overview of the industry, starting with the macro economy. First of all, we've got a little typo in our PowerPoint. It should say that the unemployment rate is going to stay below 3.5%, which is about where it is now. But inflation is going to track that 2% target. The Federal Reserve did cut interest rates twice in 2019, 3 times in 2019, but we expect those interest rates to stay low throughout 2020. We don't expect them to increase or decrease them. In general, the domestic economy is expected to remain strong. We're going to continue to see GDP growth, although it is going to be slightly hampered. This is because of many geopolitical factors, such as the trade war, possible conflicts with Iran, and also things like the coronavirus. But in general, these will be mitigated, and we're going to see strong GDP growth. Moving forward, as Caitlin mentioned, most of Banner's, or at least about half of Banner's loan portfolio is in the CRE market, and we expect that to grow sustainably through 2020. The S&P Case-Shiller seasonally adjusted national home price index did increase at 3.1% in 2019, and we expect home prices to continue growing. This bodes well for Banner because obviously it's going to continue to increase their revenue as they're able to gain interest on the price of these homes. We also see that the target markets in which they operate are growing above the national average. The United States is growing at about 0.5%, but Washington is growing at 3.5%, Oregon at 2.5%, and California at 1%, which again are Banner's target markets. And then as you can see, Banner has an above average market share in Washington and Oregon, which in connection with the previous graph that you saw bodes really well for them because they're going to be able to capitalize better on these growing states. As Caitlin mentioned, an aggressive acquisition strategy is really important for bank growth into the future. In 1994, 25% of assets were controlled by banks with under $1 billion under management. Today, that's only 6.6%. This reflects the changing trends in banking today. So Banner has really stood up to the test on this, and they've been aggressively acquiring banks, and they will continue to do so in the future, which puts them at a $12 billion approximately asset valuation right now. Furthermore, banks have really been pressured to digitalize in the recent years to match the technological offerings of larger banks, and Banner has really put a focus on these customer service related offerings and have stepped up to this challenge. We will also see an evolving regulatory climate, starting with consumer privacy likely, and just also the way that banks manage assets. These regulations are always flexing, and it will present an expense, but it's not going to be any more than what we've seen in the past with evolving regulations. Moving on, we did a little bit of a comparative analysis. As you're looking at this radar chart, the outside is better on ours. You can see that Banner is ranked number 2 in their peer group of 16 other banks. They have an above average cost of funding, yield on earning assets. Sorry, they rank well. It's below average, so it's a good cost of funding. They've got above average yield on earning assets and net interest margin, and their return on equity and price to book are at about the average mark. Just for scale, that little gray diamond in there is the worst performing bank in the peer groups. You can see the magnitude there.
And looking more closely at Banner's ROE and interest margin and yield earning assets, they have about a 0.5% advantage in terms of their ROE and interest margin compared to their peers, and about a 0.25% advantage in terms of their yield earning assets as of 2018. Furthermore, we anticipate growth in their earnings per share, and more so than their average comparison. And for 2020 and 2021, we anticipate that their PE will also be lower than their peers. Giving us our valuation, we used a blended valuation approach using the dividend discount model, the price to book model, and earnings per share times price earnings. In our dividend discount model, we anticipate moderate to strong dividend growth, as well as a long-term ROE of 9.5%. Furthermore, we found that the average one-year forward PE was about 14.5, and we anticipate that Banner's average one-year forward PE will be a little bit higher, about 15.
All right, on to the numbers, the good stuff. So we used a blended valuation model consisting of the dividend discount model, price to book, and earnings per share times price earnings. The dividend discount and price to book were essentially in agreement in that upper 50s range, and earnings per share times price to earning was about at 64. We essentially wrote this of 50-50, with 50% of our valuation being based on the balance sheet and 50% of it being based on essentially market valuations. We think that these are both really important components in a bank's valuation, and it's important to weigh them equally. So again, these blended together give us a valuation of 61-63, which will give us our 14.5% upside.
So what risks does face Banner Bank? And these risks, mind you, are facing all these banks, not just Banner alone. There's competition, which is seen in the migration of corporate headquarters leaving California and into other states. We see that they're moving towards places like Austin, Texas, and Seattle, Washington, which Seattle, Washington is great for Banner as a way to mitigate this risk, as they have a lot of locations surrounding this area. There's also market risk, which is seen through consumer spending, which is going to, or is predicted to decrease by 0.4%. We also see that Seattle housing market is increasing in prices, and there's a general cool down in real estate in the U.S. For regulatory risks, we see that there's a change in GAAP, which means that banks have to recognize credit losses upfront, which means more cash will be used to reserve for these losses. And then we also have the Durbin Amendment, which means that banks cannot, they'll just have to limit fees on debit cards. But they can mitigate this risk because they are still seeing a 14% year-to-year increase in earnings from core operations.
And even with these risks, we think there's a tremendous potential for investors to add Banner Bank to their portfolio, because they have a strong and growing deposit base, especially with the acquisitions in recent past, and their, strategy to increase its non-interest-bearing deposits. Also, further limit its growth in funding liabilities and funding costs. In addition, we anticipate that they'll have a strong net interest margin and yield on earning assets, which is good in a low interest rate environment, especially if they start decreasing further. And finally, we anticipate growth in its earning assets and earnings per share. And again, this gives us a 14.5% upside buy rating on Banner, with a target price of 61.63 due to its strong performance among its peers, its aggressive growth strategy, the CRE growth we're seeing in the service area that they have, and its low PE relative to its peers.
Okay, thank you very much, and we're open to questions now.
So Banner is very kind of susceptible to interest rate movement, and the Fed has 1 to 2 kind of interest rate cuts kind of predicted right now. How did that kind of play into the models and valuations that you had, and how do you see that kind of affecting profitability moving forward?
Yeah, so we actually expect cost of funding to stay pretty low because of these interest rates. In our research, we think that the interest rate is actually going to stay pretty stable, definitely low, but stable. So we don't think that it's going to have any more of an outsized impact than it already would have in the cuts that we've seen in the past. So the worst of that is kind of behind us.
And then for the net interest margin that you kind of brought up a little bit, it looked like that had been decreasing over the last year or two by almost like 50 basis points. Do you see that trend to continue, or do you think that you guys are going to be able to kind of maintain that margin?
I think you'll be able to maintain it. Like I said, it kind of depends on how the interest rates are cut or not cut into the future. But I think that Banner's in a position to maintain its relatively strong net interest margin into the future.
And one more question for me for non-performing assets. It looked like there was a write-off in fourth quarter of 2019 that actually doubled the write-offs from the previous quarter. What was that from, and do you see that to continue in the future?
I don't think we looked into the write-offs as much. So we didn't
Yeah.
look at that in our analysis.
I mean, I definitely don't know for sure, but based on the fact that they just had that big acquisition, ballparking, it could have something to do with that. Obviously, I don't know for sure, but if it is something like that, it probably won't be reoccurring. We wouldn't see that going forward, possibly with other acquisitions, but the benefits are going to outweigh the cost in that kind of scenario.
Okay.
On slide 6, you guys talk about the recent M&A activity. I guess, do you know how much they paid for Alta Pacific?
Let's see. This one here. Oh,
There.
I don't have the number off the top of my head. I do know that the asset size of Alta Pacific was about 420 million.
Okay.
But that's the only information that we have on that
Sure.
acquisition.
Yeah, that's fine. And then slide 4, you guys talked about their loan portfolio.
Yeah.
I guess a couple questions on this one. How does that break down geographically?
It doesn't.
Well, that one doesn't. But overall, how does that pie chart break down by geography? Like where are they? That tells us the verticals that they're in, but by geography, where are most of their loans?
So we didn't look at the loans that Banner Bank has in each specific geographical region.
Mhm.
This was just an overview of Banner Bank in its entirety. And the point of this was just to show that almost half of their loan portfolio is in commercial real estate multifamily loans.
Mhm.
And then we also talked about the growth in this sector, which I guess helps with their evaluation.
Sure.
But we do know that the growth in Seattle, which is where a lot of their assets are located, is going to be reflected in this. So Seattle is at least one of the regions.
Sure. And how does that stack up? I mean, did you look relative to their peer group, what their overall portfolio exposure looks like relative to peers? I mean, if you guys listen to the peers on slide 22, did you look at how they stack up versus the peer group?
They're definitely more heavily concentrated in CRE. Usually it would be a little bit more spread out. So
Mhm.
that's definitely a heavier concentration for them, which is why we focus so much on what the CRE market's going to do.
Okay, yeah, that's good. And then I guess dovetailing into the competitors, I'm assuming slide 20 lists or has the logos of all the competitors. That's who made up your comp analysis. Is that right?
Correct.
Yep.
Okay. And so I guess what did you find? I guess the next slide is peer group ranking. Thanks. What did you find in regards to how Banner is valued relative to its peers? And obviously you have a buy recommendation on it, but I guess I'd be interested for you guys to expand on that, how Banner looks versus the peer group.
As far as like a forward valuation,
Valuation and maybe why it trades where it trades today. Just some thoughts around that.
so as of now, their PE is lower than their peers.
Mhm.
However, we think that the market undervalues Banner. So I guess I don't know if this answers your question, but we see that Banner is an attractive investment moving forward just because of the undervaluation of it on its PE.
And how many peers were in that ranking, just so I understand that?
16 others,
16,
so 17 including Banner.
Okay. Great,
And then
thanks.
this is a graph of all the-
Yeah. Excellent.
I don't know if you guys did any work on their loan portfolio, but within their loan portfolio, is the majority of the loans floating rate or are they fixed rate? Or how should we think about the loan portfolio and how much risk is there? And if you were running a bank, would you want a fixed rate or a floating rate portfolio?
To answer your second question, I would want a fixed rate, especially with what happened in 2008 we were seeing subprime mortgages being lended out and ended up having a huge impact on the economy. So I think having a fixed rate, I guess more so a fixed rate portfolio would be better off. Can you repeat the first question again? Sorry.
No, you answered it, and I disagree with you, but because if interest rates go up, they get bigger.
Yeah, it depends on the market.
Versus if they're floating rate, then when rates go up, then they benefit, they make more profit. But on the flip side, that could squeeze companies, so you can argue on your side.
Sure.
So as I read your group, so in terms of you guys have mentioned the coronavirus, how do you see that potentially impacting their business being a regional U.S. bank?
Yeah, so I just heard a statistic this morning that the coronavirus could have about a 0.5% impact on US GDP. Obviously, there's a lot of imports and stuff coming from China. It might not do anything specifically, but in general, if domestic GDP slows, that's going to have an impact on Banner Bank. We could also see that potentially be a catalyst for a future rate cut if that were to come. I mean, our research said that it wouldn't, but that was also 2 months ago before this was a problem.
Yeah.
So theoretically, that if it really comes to worst case scenario, that could be a catalyst for another rate cut or more moves from the Federal Reserve, which would definitely have an impact on Banner.
All right, that's a great response. You guys have another one? I forgot what I was gonna ask.
Sure. I'll ask the question. So what environment do you think is the best for this business? When do they make the most money?
So I think that this is a coined phrase that I missed, but in our paper, we talk about which I know you're not really funny, but we talk about the northern migration, which is people moving essentially into the Seattle area because it's extremely hot in Arizona, basically. And that environment is fantastic for Banner. We love seeing people moving north into the Seattle and Oregon area. So that's the best possible case scenario for them. I also think that this trend of increasing real estate prices, while it could maybe hinder consumer interest in spending or send them to other places in general, because these are where the jobs are, people kind of don't have an option, so increased real estate prices are going to be good for their bottom line.
And this graph kind of summarizes what Ashley's pointing out. We're just seeing a higher growth in the states that they service compared to the country itself.
Sure. And so maybe more specifically, what type of interest rate environment would Banner want to see? What would be the best environment for their business? What kind of interest rate environment would be the best?
Well, I mean, interest rates rising helps all banks because it helps their net interest margin overall. But as far as, I guess, comparing them to other banks, I'm not entirely sure.
Banner's kind of trying to move into liabilities where they're not having to pay interest out. So I think that if they continue that trend, then they definitely want to see rising interest rates because they don't have to worry about the rising cost of funding as well.
So the question I was trying to find when I was fumbling around is, I noticed you guys use the dividend discount model for one of your valuation metrics. How should I think about like the different deltas within that model in terms of, is their payout ratio really low or really high? Like, what's the likelihood that they may have to cut the dividend if the business slows? Like, how should I think about that under kind of like a stress test?
So the future dividends are essentially going to be really dependent on their acquisition strategy. What we've seen in the past and what we'll continue to see in the future is as they continue to acquire, like every time they acquire a bank, the dividend's going to drop, which is what we saw in Q3. I think we said Q3 of 2014 or Q4 of 2019, the quarter in which the dividend was down 70%. Q3, right?
Yeah, due to the acquisition related expenses.
Anyway, so that's going to be the biggest contingent factor. However, we're developing synergies because of these acquisitions, which are going to, like Alta Pacific has a lower or a higher yield on earning assets. So if we continue to acquire banks that have these strategic advantages, then that's going to help with the dividends in the future.
And then as online companies are kind of developing a lot of technology and banking, you're seeing the younger population kind of move to that. How is Banner kind of looking at technology, and are they a leader or kind of laggard moving forward in technology?
I mean, all banks are following the national banks, right? All regional banks are kind of laggards, but in general, from our research, we're pretty satisfied with their technological offerings. It's not like they're, I guess, U.S. bank with cutting edge everything.
Yeah, it depends on who you compare them to. So if you're comparing Banner to, say, Wells Fargo, or actually, say, U.S. Bank, it's a lot different than comparing them to, say, a small regional bank in the area. So it's all relative. That's that.